Hello, this is the recording on FIN4801, Advanced Financial Management. So in the previous class, we started looking at this module and we touched on some of the key study units. We started with Chapter 1, an overview of financial management, and we also looked at the time value of money. And once we completed the lesson, I asked you to look at some questions as practice. So I'm just going to take you through the questions I asked you to look at for practice, and then I'll take you through risk and return. I think we had also started looking at risk and return in the last class. So I asked you to look at some time value of money questions, which are found at the end of chapter 2. I'll put them up and then we'll work through them, self-study problems. I just wanted you to become familiar with using your financial calculator for different calculations. In this module, there'll be a lot of calculations which involve using your calculator, so you should just be comfortable with that. So I'll just work you through some of the self-study problems I asked you to look at, and then we'll finish off chapter 3, risk and return. So one of the first question I asked you to look at says you deposit 10,000 in a bank account, which pays 4.8% per year interest compounded annually. How much will you have accumulated in the account in 5 years' time? And what will you have accumulated if interest is compounded monthly? Okay. So this is what you were supposed to do. The inputs are shown right up on the screen. You were supposed to enter your PV 5 by 12 because it's monthly compounding, 4.8 divided by 12 as your interest, and then you calculate your future value. So I'll also just show you that, show you how you would input that. A lot of this is revision, but I'll just show you how you would input that into a financial calculator. So the emulator I have is for an HP, so I'll just take you through that using an HP calculator. A lot of this is just revision. So you would just put your 10,000 as a negative, then you would say 5 by 12, as in 4.8 divided by 12 as your interest, and then you would get your, actually first you should check to see your calculator is on 1 PYR. Okay, it is. So we would say 10,000, that's our PV, 5 by 12 is our N, 4.8 divided by 12 is the interest, and then we would get our future value. Okay, so that's how you would do that. So you always make sure to check that your calculator is on 1 PYR. Then the next question said you have purchased a motor car for 120,000 Rand and you have obtained a car loan for the total amount which requires you to pay this amount over 5 years at an interest rate of 7.2%. If the interest is compounded monthly, determine the monthly payment required for the 5 years if the first payment is due immediately. Okay. So again, you were supposed to put your calculator into beginning mode because you were told that the payment is due immediately, and then you were just supposed to enter in those values. So remember, to put your calculator into beginning mode, you would press the red shift button, and then you would come to beginning, BEG, and then you would enter in your cash flows. Starting with your PV, 5 by 12 would be your N, 7.2 divided by 12 would be your interest, and then your PMT would be 2373.24. And then when you're done, always be sure to put your calculator back into its original mode. So this is just revision, but occasionally questions might pop up where you need to use your calculator. Question 3, what is the present value of a zero coupon bond with a par value of 100 Rand, which is due to be redeemed in 10 years' time, when the current market interest rate for such a bond is 6% interest compounded semi-annually? We're going to look at bond valuation later on, but for now, FV, the par value, that's 1,000, 6% divided by 2, that's the interest. Because it's semi-annual compounding, we divide by 2. 10 times 2, that's N. Because it's a 10-year bond, it's redeemed in 10 years, so we multiply by 2. And then we calculate the PV, right? Question 4, you wish to purchase an apartment in Port Elizabeth, which is situated in a tree-lined avenue. The purchase price, which costs 710,000, and you are able to obtain a 100% mortgage loan at an interest rate of 6% interest compounded monthly. The term of the loan is 20 years. Assume that property values are expected to rise at a rate of 9% per year, which is 0.75% per month. You will be able to rent out the apartment after costs at a rate of 4,000 per month for the first year. Interest and rent are payable at the beginning of the month. What is the expected value of the apartment in 20 years? What is the mortgage loan repayment at the beginning of each month? What is the net amount you have to pay in each month? So, first of all, you are supposed to get the future value of the apartment, given that the apartment is currently costing 710,000, which is the PV, 20 by 12. Because the apartment is going to increase in value over the 20-year loan, and it's going to increase in value at 9% per year. 9% divided by 12 gives us 0.75 per month, and then 20 by 12. So we divide and we multiply because it's semi-annual compounding. We put our PV as minus 710, and then we get the future value. So this is how much the house will be worth in 20 years. But you are going to get a loan from the bank that you have to pay back. So you're also asked to calculate what is the mortgage loan repayment at the beginning of each month, right? So we enter in the current price of the house, 710. We say 20 by 12 for N, 6% divided by 12 for interest. Then we calculate our PMT. Okay. So these were just questions just to get you comfortable with your financial calculator, nothing too hectic. And then there was this long question. I'm not going to read it, but you can put on pause and then you can just read the question to familiarize yourself with it, or you can read it from the textbook. It's the last question, and it goes all the way up until the next page. And then you ask some questions. What is the present value of Rooney's after-tax earnings at 1 July 2014? And what is the present value of Ronaldo's after-tax earnings on the same date? How do they compare? So with this question, basically, you were given two soccer players, right? And then one of them had image rights, and we were told that these image rights increase by a certain percentage each year. We were told that they increased by 7%. So initially the image rights were 1.8, and then that 1.8 was increased by 7% to 1.926. 1.926 was multiplied by 1.07 to increase it to 2.061. This 2.061 was increased by 7. So they just increased the image rights each year by 7%. They also took his salary, and the salary was also increasing. I think we were told that the salary from June 2016 will be 15.6, and before that it was 13. And then if we add those two, we get the total amount that this player will be getting. Then we remove tax of 45%, and then we get these after tax earnings. And then what we wanted to do, we wanted to determine the present value of these after tax earnings. So that's what I've put up here, the present value of the after tax earnings. Oh, by the way, in the previous question, you were also supposed to find the difference between how much you'll be paying and how much you'll be getting as rent. But anyway, so once you've determined the after tax earnings, we were supposed to find the present value of the after tax earnings. And to do this, again, we can use our financial calculator, right? So what I'm more important with is showing you how the financial calculator works, not how to construct those problems. Okay, so you were supposed to clear the calculator first, right? And then we put in 0 for the first cash flow. In years at times 0, it's always 0. And then you'll see we've got 8.209, 9.713. So we input each of those cash flows into our calculator. 8.209 cash flow, 9.713 cash flow, 9.793 cash flow, 9.878 cash flow, 9.969 cash flow, and then 5 is our interest. Then we press the red shift button and we get the present value of all the cash flows that the first player, Wayne Rooney, is going to get. Okay. So we were also given information on Ronaldo. We were told how much his image rights were, and we were told that they are going to increase by 7%. So they started 15 million, and then we increased 15 million by 7%, and then we increase the answer we get, which is 17 by 7%. Maybe let me just illustrate to you how you would increase that, just to help you to see how it would actually work. I'll just put up a calculator here. Okay. So this is how we would increase those amounts. It's important to know how to increase amounts, right? Okay. So we would clear our calculator, and then initially the amount is 15, right? And then we increase 15. We were told that is image rights. You can just reread the scenario just to remind yourself. But we were told that his image rights would increase, right? Initially, we were told that his image rights would be going up to 17 million, right? In 2016. And then from that 17 million, they are going to increase by 7%. And that's how we got 18.19 for June 2017. And then this 18.19 is going to increase again by 7%. Remember, if you want to increase something, you just take it and then you multiply it by 1 plus the percentage you want to increase by. And then we get 19.463. So that's how these numbers were obtained. Okay, we're just increasing. You just take that amount multiplied by 1 plus the amount you're increasing by. And then we remove tax. We were told that the tax for where Cristiano Ronaldo is 52%. 52% of these amounts, we get these values. And then this is the salary after tax. And then we get the after tax earnings of these amounts. And then we wanted to find the present value of these amounts. So you'll notice that in the textbook, they were using present value factors, right? These amounts, the that I've just blacked out, these are present value factors. Okay, these ones, they are present value factors, but we can use our financial calculator to discount these cash flows rather than using present value factors. Okay, so I'm going to show you how we would use our calculator to actually discount these cash flows. Okay, let me first put them up. So these are the cash flows that I want to discount, the cash flows we got. So I can use my financial calculator to discount these. I'm just working under the assumption that we're using an HP, but I know some of you might have a Sharp. So you would clear your calculator, 0 cash flow, 22.2 cash flow, 25.72 cash flow. So that's actually 25.76. 0, we always start with 0 because these cash flows are being obtained at the end of the year. It's the end of the first year, we get 22.2. End of the second year, we get 25.76. End of the third year, we get 26.331. End of the fourth year, we get 26.942. End of the fifth year, we get 27.596, right? 5% is the interest, and then shift, we get 111.04. So that's how we got this value right here. So clearly you can see that this player, Cristiano Ronaldo, has a higher net present value of his payments compared to Wayne Rooney. So that's what we were asked to calculate here, right? Okay. So what you can also do, just to help you understanding on those concepts, you can also attempt question 2, 3, 4, 6, 8, 10, 14, 15, 18, 20, 24, 27, 31, 35, and 41, and 43 under these questions. These questions are good practice. They'll help you to become more familiar with your financial calculator. The solutions are found in your handout, I'm sure, under study unit 2. Here they are. Here are the solutions. If you don't have the handout, maybe you can just check your answers with these solutions that I've just scrolling through. Okay. And if you need assistance with any of these questions, if you can't get the answer, then please let me know if you don't know where it's coming from. But otherwise, please try these questions. They're on page 2-42. They start on page 2-42 of your prescribed textbook. They are just good practice in terms of helping you to become familiar with your financial calculator, which is very important. So please try those questions, okay? So we've now looked at learning unit 1 and we've looked at learning unit 2. I now want us to finish off learning unit 3. We started looking at this last time, but I'll just go through it again from the start in case some people missed the class, or just to help you all. So remember, learning unit 3 is titled risk and return. It's titled risk and return. And there are a number of learning objectives. So I'm going to take you through the important concepts with regards to the learning objectives you're supposed to know. So firstly, you're supposed to be able to distinguish between business risk and financial risk. You're supposed to be able to distinguish between what we call business risk and what we call financial risk. Okay. So we define business risk as follows. Business risk is any risk that threatens a firm's ability to generate profits. And this risk arises due to the inherent nature of the business itself. So when you're operating business, there are certain risks that arise due to the business that you're running. And some of these risks, some examples, are higher costs than expected. You might budget your costs at the beginning of the year, but they might end up being higher during the course of the year than expected, or even during the course of the month if you're budgeting monthly. The next cause of business risk is stronger competition than anticipated. Sorry, there's supposed to be a D there. You might anticipate that you'll be able to sell your product without a lot of competition, but the competition might end up being more than you originally anticipated. So that's also business risk. Even technology changes, or even a fire at your premises. These are all business risks. They're just risks that can disrupt your business due to some unforeseen circumstances. Okay. But you should be able to distinguish between business risk and financial risk. And financial risk is defined as follows. This is the risk that a firm will have high finance costs, meaning high interest expenses. This is the risk that a firm will have high finance costs or high interest expense, and they'll have insufficient funds to meet these fixed finance costs on time due to high levels of debt. So in other words, if a company has a lot of borrowing, let's say a company has borrowed a lot, they have to pay a lot of finance costs and interest expenses. So when a company's interest expense becomes too high for them to be able to pay, if the fixed interest expense becomes too high for them to pay due to low revenue or low operating profit, we say that the company is exposed to financial risk. So we can also define it as follows. This is a risk to the company due to how it decides to get its long-term finance. Remember, a company can either get money through borrowing or through shares. If the company decides to get money through borrowing, they expose themselves to financial risk, whereas if they get money through shares, they do not expose themselves to financial risk. So in this chapter, the first thing you're supposed to know is how to distinguish between business risk and financial risk. And then the next thing you're supposed to know, you're supposed to also know how to measure risk and return. There are different ways of measuring risk and return, right? So I'll briefly talk about measuring return. There are three approaches to measuring return according to your prescribed textbook. Return can be measured using operating profit, also known as earnings before interest and tax. It can also be measured using to shareholders, percentage return to shareholders, right? And it can also be measured using expected return based on probabilities. In the previous class that I made, I think I had incorrectly given you a wrong formula here, but I've corrected it in this video. Percentage return to shareholders is not the same as return on equity. I think I had given you the formula for return on equity, so please do fix that in your notes. So let's briefly talk about how you can calculate each of these, how to measure earnings before interest and tax, percentage return to shareholders, and expected return based on probabilities. So we'll start with earnings before interest and tax, EBIT, how to measure this. Okay, so EBIT is the measure of past return. Okay, so when we talk about EBIT, it's measuring the return that you've achieved in the past, not expected return, right? It's a measure of past return. And to calculate EBIT, which is also known as operating profit, you use this template. It's a very important template that you need to remember. You take your sales, subtract your variable costs, then you're left with your contribution. The contribution is also known as the gross profit. And then you subtract fixed costs. Fixed costs are also known as operating expenses, and then you get EBIT. So this is the basic formula to calculate EBIT. I'm sure you've come across this formula in a lot of your previous studies. It's your sales, less your variable costs, you're left with contribution, also known as gross profit, less your fixed costs, also known as operating expenses, and then you get EBIT. Okay. And then percentage return to shareholders. This is also a measure of past return. Remember, I've said that EBIT is also a measure of past return. So percentage return to shareholders is also a measure of past return. And then to calculate percentage return to shareholders, you use the following formula. You say P1 minus P0 plus D over P0. that will give you the percentage return to shareholders. RS is the return to the shareholder. P1 is the share price at the end of the period. P0 is the share price at the beginning of the period. D is the dividends received during the period, right? And P0 is the share price at the beginning, like I've said. So this is how you would measure the percentage return to the shareholder. So here's an example of how you would do that calculation. If you've done FIN4701, you might have come across this before, but if you haven't, it's fine. A share at the price of 30 Rand at the beginning of the year. At the end of the year, the price was 45 Rand. If the investor in the share received dividends of 2 Rand 50, determine the percentage return to the shareholder. So we just take the price at the end of the period minus the price at the beginning plus the dividend divided by 30. To avoid BODMAS, you should work out the first part and then you get the bottom part, then you divide and you get 58.33%. Okay, so that's how we would get the percentage return to shareholders, right? And then the last way to measure return is the expected rate of return based on probabilities. And this is different from the other two measures in that this is a measure of future return. So the expected rate of return based on probabilities is a measure of future return. So we can look at a question in the textbook just to remind you. I'm also sure you've come across this before, but we can look at question 3 on page 3-35, self-study problems, 3-35, page 3-35. It's actually the questions. We can look at this question right here. Question 3.10. Yeah. Lighthouse Limited is considering investing in a project that may offer the following possible rates of return. So these are the possible rates of return and these are the probabilities. And then we are asked to calculate the expected return of the project. In other words, we are asked to calculate the future return of the project, okay? Expected. So to do this calculation, we use the following formula right here, expected return. We take each return and we multiply it with its probability, and then we add those up. Each return multiplied by its probability. Ri is the return in state I, and Pi is the probability in state I. So what you can do to answer such a question, I would advise you to create a table like this, and then to put your probabilities as decimals. As you can see, I've changed these percentages into decimals, right? And at the same point, you leave your returns as percentages. You leave your returns as percentages. And then you multiply each probability with its return. Each probability multiplied by its return, and you get these expected returns. And then you can add them up to get your final answer, which is 12%. So I'll repeat that. Change your probabilities to decimals. Multiply the answer you get by the corresponding return to get the expected return. And then if you add those up, the final answer you get, the total will give you the expected return. Okay, you've done this before, so a lot of this is revision. So you could also do it this way, but this way is a bit longer and you would need to change everything into decimals, right? Or in other words, you would need to divide at the end. But I think the best for this module, I think the best thing we should do, let's stick to this table. You could always write out the formula like this and just put the inputs into your calculator to get the final answer. But I think just to be careful, agree that when we do questions in this module, you'll see we'll get some questions in the assignments and in the exam. Let's just stick to this method. But with this method, you just have to make sure that you're extra careful with your multiplication and when you add up. to avoid making mistakes. Another option, of course, would have been to do it this way. I'll just show you based on what I put. We could have said 0.1 multiplied by minus 30 plus backspace 0.2 multiplied by open bracket minus 5 plus 0.4 close bracket multiplied by 15 plus 0.2 multiplied by 30 plus 0.1, okay, delete 0.1 multiplied by 40. Okay, we would get the same answer. But here you would just have to be careful that you've put in everything. So there might be part marks with the table. You'll get the part marks in case you miss something out. Okay. So those are the measures of return that you're supposed to know about. Now let's talk about the measures of risk. Now when it comes to the measures of risk, we have 7. Actually 8. 1, 2, 3, 4, 5, 6. It's actually 8. We have 8 measures of risk. We have degree of operating leverage, DOL, degree of financial leverage, DFL, degree of total leverage, DTL, variance of returns, standard deviation of returns, coefficient of variation, the Z-score, and the covariance and correlation. Now, these two are very statistical in nature. You would find them maybe in a statistics module. In this module, I doubt you would be asked to calculate these. They wouldn't come up. We'll see as we're looking at capital budgeting questions, they might ask something on these two, so we might come across them. But the Z-score, no, that won't come. Okay, it's a bit of some statistics that will just take us time, and it's not paramount as these other ones. These other ones are the very important measurements. So I'm going to take you through each of these, and then we'll see these later on when we look at capital budgeting and we're doing questions to see if they come up. So we've got degree of operating leverage, degree of financial leverage, degree of total leverage, variance of returns, standard deviation of returns, coefficient of variation, and then these two, the Z-score, covariance, and correlation, the ones I was saying, are not as important as the top ones there. So let's start by looking at leverage. You've also come across leverage before, so this is some revision. Leverage can be split into 3 types of leverage. We have what we call operating leverage, we have what we call financial leverage, and we have what we call total leverage, right? We have operating leverage, financial leverage, and total leverage. The degree of operating leverage is given by the following formula. So we measure operating leverage using the degree of operating leverage. We measure financial leverage using the degree of financial leverage, and we measure total leverage using the degree of total leverage. So the idea behind leverage is that you're using fixed cost finance. You're using fixed cost finance. In other words, you're raising money through fixed cost finance, and then you're trying to use that to either improve your EBIT, or to improve your sales, or to improve your net profit, your earnings per share. So let's briefly talk about each type of these leverages, how they are measured, and the calculations involved. So with the degree of operating leverage, operating leverage is measured by the degree of operating leverage, and this is the formula. It's contribution over EBIT to get the degree of operating leverage. The degree of financial leverage is EBIT over EBIT minus interest expense, and the degree of total leverage is given by the contribution over EBIT minus 1. We can also get degree of total leverage by simply multiplying degree of operating leverage, and degree of financial leverage. So let's briefly talk about each of these, okay? So the degree of operating leverage is a measure of how sensitive a company's EBIT is affected by a change in sales. The degree of operating leverage is a measure of how sensitive the company's earnings before interest and tax is affected by a change in earnings in sales, sorry. So let's say we calculate the degree of operating leverage to be 2, right? Let's say we calculate the degree of operating leverage to be 2. This means if our sales change by 10%, then our EBIT will change by 20%. Our EBIT will change by 2 times the change in sales. So this would be the degree of operating leverage. That's what it tells us. The degree of operating leverage, if it's 2, it tells us if our sales change by 10%, then our EBIT will change by 2 times 10%, which is 20%. Okay. And we calculate it using this formula right here. The degree of financial leverage is a measure of degree of financial leverage is a measure of financial risk. Remember, we talked about what financial risk is. It's the risk of having a lot of fixed interest expenses, and then your sales aren't changing, or your sales aren't as high. So it is a measure of how sensitive a company's earnings per share is affected by a change in the company's EBIT. It's a measure of how a company's earnings per share is affected by a company's EBIT. So the same applies. Let's say the degree of financial leverage is 2, and let's say our EBIT changes by 10%. This would mean that our EPS will change by 20%. So let's say earnings per share changes by 10%, and our degree of financial leverage is 2. Let's say EBIT changes by 10%. If we say 2 times 10%, we get the change in our earnings per share. Okay. So leverage can be positive or negative. If it's negative, it means as one value goes up, the other is going down. Then lastly, we have degree of total leverage, and this is a measure of how sensitive a firm's earnings per share is to a change in sales. It's a measure of how sensitive a firm's earnings per share is to a change in sales. The same applies if the degree of total leverage is 2, and let's say our sales change by 15%. It means that our EPS is going to change by 30%. Okay. So just to help you with these measures of leverage, which I'm sure you've come across before in your studies, I want you to look at this question as homework, and then I'll give you the solutions in the next class. Question 3.6. The question is up here. I hope you can see it. Yeah, question 3.6. I want you to calculate A, B, C, and D, and also the break-even points. This is just some revision. There are things that we've done before, but I just want you to try that, and then I'll give you the solutions. Use the formulas that I gave you up here to help you to calculate the degree of operating leverage, degree of financial leverage, and the degree of total leverage. Okay. And when you're doing that calculation, please remember that the break-even units are the number of sales such that all the firm's fixed costs are covered. So this is also closely related to leverage. It gives us the number of sales in units such that all our fixed costs are covered. And to calculate the break-even units, we take our fixed costs, the total fixed cost divided by the contribution per unit. The contribution per unit is simply our selling price per unit minus variable cost per unit. That's the contribution per unit. It's simply the selling price per unit minus the variable cost per unit. Okay. Right. So I want you to try this question, and in the next video, I will take you through the solution. And then you can also measure risk. Remember, we're looking at ways of measuring risk. I've taken you through all the leverage measurements. I now want to talk about these 3. We can also measure risk using the variance of returns and the standard deviation of returns. We can also measure risk using these two. You might also be familiar with this. The variance of returns, we'll use this formula. We take each probability multiplied by Ri minus R bar I. This would be the expected return, and this would be the return in state I, and we square that. So I'm going to use this example again. This example, the one I used before. Remember, we got an expected return of 12%. I'm going to use it to calculate the standard deviation as well as the variance. Okay. So again, I think we should just stick to using the table. I know you can enter this into your calculator directly to get the answer, but for this module, let's just agree to use the table. So you always change your probability to decimals, and then here we have our returns as percentages. And then what you do, you take each return, like this minus 30, and then you subtract the expected return, and we got the expected return before of 12%, right? Minus 12%. And then you square that, right? And then you get 17.64. Okay. So how would we do that on our calculator? We would clear our calculator, and then we would say open bracket minus 30, right? Minus 12. Remember, if you start with minus, you press this one, not this one. Then we close bracket and we square that, and we get 17.64. So we keep doing that until we've calculated all our values here. 17.642899324784, and then each of these amounts is multiplied by the probability. So we say 1764 times 0.1, 289 times 0.2, 9 times 0.4, 324 times 0.2, 784 times 0.1. We get these amounts, then we add them up, and that gives us the variance. And then the standard deviation is simply the square root of the variance, which gives us 19.52%. So these are in percentages. And then lastly, we have the coefficient of variation. The coefficient of variation is simply the standard deviation divided by the expected return. So using that previous example of ours, remember this is the standard deviation we got, and this is the expected return we got of 12%. We can just divide those two, the standard deviation over the expected return, and we get 1.63. So this is also known as the coefficient of variation. And the good thing about the coefficient of variation is that we can use it to compare investments. And when we are comparing investments, let's say we want to choose between two investments, the lower the coefficient of variation, the better, right? And like I said, we also have these other measures of risk, but these ones, we'll touch on them as we work through examples. They're not as important as the ones I've taken you through. Okay, so please try to work through the questions I've asked you to look at. Try to look at this exercise, and then in the next video, I'll take you through it. And also try to look at these questions. The answers to these questions are given right here in your handouts, the handouts you find on my UNISA. If you have any problem with any of these questions, feel free to let me know. Okay, so thank you for listening. I hope this video has been helpful. If you have any queries anywhere, or if you're stuck somewhere, please feel free to let me know, and I'll try to get back to you as soon as I can. I won't always be able to respond promptly due to other commitments, but I'll try to get back to you. So we'll continue from there next week, and we'll start looking at the next learning unit. And hopefully the assignment will be out by then, so that we can start looking at some assignment questions as examples. Thank you once again.